Hey everyone, and welcome to episode 22. I think this is episode 22 of the 7investing.com podcast. Our mission here at 7 Investing is to empower you to invest in your future. We do that by providing a ton of free educational content like this podcast and by offering a monthly subscription service where our team of advisors provides our 7 best ideas in the stock market each month for just $17. I just learned how to pronounce this today, a few minutes ago, but we've got Jamin here today from Redpoint Ventures. And really one of the first places I saw you or met you online, Jamin, was through Twitter, but through your Clouded Judgment Substack. And so that's how I'm familiar with you. You are I believe according to your LinkedIn, you're a vice president at Redpoint Ventures. So I'd love for you to just spend a second introducing yourself and, maybe sharing a little bit about yourself. But then, we talk a lot about public companies at 7 Investing. A lot of people are probably familiar with venture capital and what VCs do. But if you could just provide a little bit of background on that, just so we can start to tie together maybe some of the similarities and differences between, private venture capital and then investing in public companies.
Totally. Well, first off, thanks for having me. I'm excited to be joining the podcast. So I joined Redpoint about 4 years ago. We are a venture capital firm that invests in both consumer and enterprise B2B software businesses. We've been around for about 20 years now. We have 2 different teams here at Redpoint. We have an early stage team, and it's actually an early stage fund. You can think about them as typically investing in and partnering with seed and Series A stage businesses. And then alongside that, we have an early growth fund, which is that's the team I'm on. We have about 6 other individuals on that team. We're typically investing and partnering with businesses at the Series B or later stage, right? So anything from companies with $1 million in revenue less, all the way up to companies with tens or even hundreds, and everything in between. So I focus on mainly B2B software businesses, anything at the infrastructure layer, any kind of DevOps business, application software, SaaS, or cybersecurity. Those are typically the areas I focus on. We also do a bit of healthcare and consumer, but it's not quite as much of a focus. Before Redpoint, I was over at Morgan Stanley doing investment banking. So working more with, much later stage businesses or public businesses, typically in the software and security space. And before that, I was over at Stanford. So pretty much been in the Bay Area working in tech, my whole life. And I guess to your question on venture capital, usually and kind of what we do. So at every stage of a business, typically, and the exception are companies that are bootstrapped, but typically businesses will look for outside capital to fund their operations. That might be hiring their first few engineers to get the product off the ground. Down the road, that might be hiring their first few go-to-market and sales folks to, really take a business that has, maybe a couple of design partners, something that's more mainstream with an outbound sales motion. Sometimes businesses are able to fund that with cash flows that the business generates, but more often than not, that isn't the case. And, they'll look for outside capital to do that. And we'll be that partner that kind of provides the capital, but also works with the business as they continue to grow to think strategically about their operations, right? Things like how to build a sales team, how to structure it, thinking about product vision, thinking about all the different types of things that, we get to see in every business we work with, right? The way we always like to talk about it is for many of the founders that we work with, it's the first time they're doing this, right? It's the first time they're building a company. They don't know what they don't know. Well, I mean, they're often much smarter than us, but, we've seen around corners that happen. We've seen scaling issues that happen that, businesses might not be able to predict. And so we'll help them look around corners and all of that as they ultimately look to become a public company one day. So that's a little bit more about me and what we do over at Redpoint.
Yeah, that's awesome. So I'm on the Redpoint website. So also everybody, you can follow Jamin on Twitter at JaminBall, Jamin Ball. And I'm on the Redpoint website. And a couple other things on here that are just kind of fun is your favorite hobby outside of venture is fantasy football. So that's
Yes.
you're probably struggling with that right now a little bit. And
Yes,
then,
indeed.
you've got a quote up here that you say it's overquoted, but you try to apply it in so many aspects of life. Skate to where the
Yeah.
puck is going, not where it has been. So, it's probably pretty obvious, or you feel like it's probably pretty obvious to think about how in your mind that applies to what you do investing in private companies, and then
Yeah.
also what appears to be a hobby or a passion for public companies as well. But
Yep.
where do you apply that? Where else do you apply that in your life? Might get a little
Yeah.
bit off of investing here, but still, I'd love to get to know you.
Oh, totally. I mean, I think honestly, you can, I'll give kind of a joke answer first, right? But, linking it back to my fantasy football interest, the ways you get ahead in your leagues, right? It's not with your first, second, third round pick. It's by finding that gem. Maybe it's a rookie, who doesn't have much of a track record. You don't really know what to expect. Getting them in one of the later rounds, and the idea there is, right, it doesn't matter what they've done in the past. You want to put value in where they're going or what the situation will be, right? So I apply it there. I think on like a personal level, I think, I'm got married a few years ago. We had our first child a year ago,
Congrats.
number 2 on the way. Thank you. I think there's so many different places just in my personal relationships, right, where, it helps me think more big picture, right? I want to think about, especially with, being a first-time parent, there's so many challenges that arise in being able to take a step back and, not just worry about solving the issue, at hand, but, things that will come up and optimizing for down the road and thinking more long-term. Just kind of always helps to keep that perspective.
Yeah. Yeah, for sure. That's a great quote. And we've heard it a lot, but I think, like you point out, it's an important one.
Yeah.
So let's jump in to your Substack, right? And it's I follow it, highly recommend anybody that's interested in the types of companies that we're talking about. Subscribe as well. It's cloudedjudgment.substack.com. And just from the about section, to give people a quick reference, it's a series of weekly data-driven posts that will be published on Friday mornings, where you break down latest valuation trends, operating metrics, and the metrics that are driving those trends behind the universe of cloud, SaaS, or software as a service public companies. And basically, you just talk about how, as a venture capitalist at Redpoint, you've developed frameworks that are, most of them are data-driven, to evaluate private SaaS businesses that are broadly applicable to their public counterparts. So anything you want to add up front about Clouded Judgment? I love it that your posts are long and data-driven, which I appreciate. A lot of people are looking for like real quick, just highlights. I love the depth that you go in. But what I really want to get into is those frameworks that you highlight and that you've kind of built in the private world and are now starting to apply to public companies.
Totally. And so I guess there's kind of two questions there. And what I'll start with is, the framework that, that I like to use for evaluating private businesses. And it definitely does differ a bit, just because, we're allowed and we have the time to go much deeper on the analysis for every private investment we make in ways that I just personally wouldn't have the time or the resources to do for every public investment. But, when we look at private company investments, there's really, I'd call it 5 main buckets that we're looking to evaluate. The first being the team. That's a very important one for us. It's often a needle mover. And what I mean by that is, we want to back teams, that have big goals, that have big visions, and are smart technical people, right? We want individuals who aren't looking for a quick flip. We want to back founders who, we get along with and they get along with us, but also are kind of, shooting for the stars here. And finding the right team, doing reference checks, looking at what they've done in the past, that goes a long way for us. The second big category we like to evaluate is the product. And we do that generally through a number of conversations with customers, or even conversations with customers of their competitor's product, just to kind of better figure out their positioning. And what we love to hear more than anything is customers who love the product, customers who can articulate a clear ROI and use cases, customers who can articulate how the use cases have evolved and changed over time. And then just in general, a love for the product. I mean, it's not often you hear customers who love working in a certain software, right? It's either a means to an end or it's something that was mandated by them. But when you kind of hear consistent reviews of, I love working in this product, it makes my day-to-day job so much easier, that kind of gets us excited. The third bucket we really dig in on is the market. And I guess this is kind of two buckets. But first, just being the size, how big is this market? How fast is it growing? I'd say it's generally it seems like it should be an easy bucket to quantify. It's often harder than you would think, just given, the rapidly changing nature of cloud markets and SaaS markets today. I'd say we oftentimes underestimate how big markets can be, and it's a reason we don't do deals that we should. We make far more mistakes than right decisions if you look at all the deals we've passed on. And then the second piece of the market is the competitive dynamics. We don't have a huge fund. We have a $400 million growth fund. We're probably making 4 investments a year, 4 to 5 investments a year. We want to back businesses that are the leaders in a category. So we want to find a market that we think is big and growing, and we want to find the best company in that market, the one that we think can be impactful. The fourth bucket is the financial profile. We want to dig in on the high level metrics, right? The growth. We'll break out growth into looking at things like what is the percent, how is the the net new ARR added per quarter trending, how is just the new logo ARR per quarter trending, all the different pieces of an ARR waterfall. We look at the margin expansion. There are a couple key metrics that I personally really like to track, and I kind of highlight a few of those in some of my posts. But the 2 metrics that I really care the most about are net expansion and the payback period. And net expansion, basically, for those who aren't familiar with it, it will take a cohort of customers at any given point in time and say, 1 year from now, how much is that cohort of businesses spending relative to that initial period spent? So it's inclusive of upsells, inclusive of churn or any kind of contraction. And essentially what it shows you is what that group of customers will grow to, right, without adding any new logos. And so over time, as cohorts combine, it kind of shows you what a longer term growth rate could be, even assuming no new customers are added. Or no new logos are added, which is a super interesting metric, and I think a unique part of the SaaS business model that is underappreciated. And then the payback period, that may be a little bit more of a non-standard metric, but we like to look at the cost to acquire a business. We then look at, and when I say a business, I'm talking more about a group of businesses, right? We might look at the cost to acquire all the customers from 1 quarter. We look at what the gross margin contribution is of that cohort. And then we say, how long does it take to pay back that spend to acquire the customer on a gross margin basis? And we measure that in a period of months. We like to see, call it 15 to 20 month or less payback. It's a bit of a tricky metric to wrap your head around just talking about verbally, but hopefully I somewhat explained it well.
Yeah, no, this is all great. And, you were basically talking about the venture side, I think, right?
Yeah.
And private companies.
Yeah, that's the venture side. That's the venture
But everything
side.
you said to me applies to investing in public SaaS companies. And
Totally
you hit on a
does.
couple points that I'd love to just hear you talk more about.
Totally.
You talked about sometimes it's a factor, and sometimes it's maybe caused you to pass over companies. And then if we flip that to the public side, I think this is what has caused a lot of the outperformance, I believe, in public SaaS companies is people, and you can look, Salesforce is one of the most obvious, right? They're kind of like the OG of SaaS, the SaaS category, right? They were basically the first software as a service company. Maybe technically there was another one, whatever. They're one of the most well-known. I mean, and then from them on, almost every SaaS company that you look at as a success today that's been a massive, massive winner was just serially underestimated their market size, their growth potential. And so it seems like, just like you talked about on the private side, public investors have had the exact same thing. They have significantly underestimated the potential market size for a lot of these companies. And so, we kind of jumping ahead, but we look at valuations today in public SaaS companies, and they are getting up there for sure. And some probably aren't deserved for the companies that have them. Some, I believe, are. But I guess what I'm getting at is what are your thoughts on how much that'll continue? Where, are we still underestimating the potential market size of a Twilio, a Mongo database, companies like that? Or are we getting closer to where we probably have a good understanding, and maybe most of that growth is priced in? And I'm not looking for you to make a call on any of these stocks or anything like that. It's just, I think it's one of the most important points that investors in some of these companies have to think about right now, is how much of this is priced in and how much is maybe underestimated still.
Totally. I think it's a great question, and something that's extremely relevant to what we're seeing in the markets now. And I guess just to highlight how this actually plays out, and then I'll answer the question. Years ago when we looked at Datadog, right, we thought that maybe call this like the Series A. At the time, you saw workloads moving to the cloud, right? And that entailed cloud applications, right? And that you'd have to monitor with an APM solution like an App Dynamics, and then infrastructure moving to the cloud, which you would monitor with something like a Datadog. And at the time, you look at that and you say, okay, well, how much of the market how much of the infrastructure has currently been running in the cloud today? It's not that much. Okay, so how much is a tool that monitors that going to be worth? Well, it's a fraction of a fraction, so it's not that much. And you maybe think that monitoring the applications is more important than the infrastructure, because that's when you kind of do all this analysis. Long story short, we drastically underestimated that market size, and I think it's still underestimated today by big public investors. But I guess getting back to your main question, and this is something that I've dug in quite a bit to recently. You can pull any of these big CIO surveys from the sell side investment banking research groups, and I think something that you can pull out that usually ends up being a pretty consistent number is you see about no matter how you slice and dice the data, we're about only at 20% cloud penetration today. Whether you're looking at applications being run in cloud environments, whether you're looking at number of data being stored in cloud warehouses versus on-prem warehouses, whether you're looking at the spend, just pure spend from an IT perspective on cloud versus on-prem technologies, it all ends up coming to about 20 to 25% penetration. Which I think one should just demonstrate how much room we still have left to run in cloud. You combine that with the fact that you kind of hear anecdotally, right, from all the big tech leaders. You hear from Aaron Levy all the time. You hear from Satya Nadella all the time. You hear from the Twilio team all the time, right? Digital transformations are being pulled forward, which I think we still have yet to see that in the data for Q2 earnings, which we'll see a lot this week. But what that shows to me is that we still have, one, a lot of room to run, but two, the adoption is accelerating, right? It's not a linear trend to get to, and we probably won't ever get to 100% in the near term, right? But we might get to 40, 50% just in a couple of years. And when I see that, and I see the public market multiples, people are factoring in high sustainable growth rates for a longer period of time than normal. And you look at someone like Salesforce, who's doing billions of dollars of annual revenue and still growing 30% year over year. I mean, their growth rate at that scale is phenomenal. And so you kind of have to take a step back and think, the only companies that are really going to be able to sustain these growth rates are ones who are going to be able to really take advantage of the fact that more and more workloads or data storage is being moved to the cloud. You look at some of these metrics like net revenue retention, you see a company like Twilio, I can't remember what their exact number is, but it's north of 130%, right? And so you say, okay, if that company can grow and on 130% net rev retention rate, that means as a whole, the business will grow 30% year over year without adding any new customers. A number greater than 100 just means they're expanding. Less than 100 means it's contracting. So you look at just what they're growing on their existing base of business, they can grow 30% plus, or I think it's even close to 40% plus year over year, adding no customers. So then you layer on new logos, right? And the growth you get from new customers, it's really, you don't really have to squint too hard to see a business that can grow 50% plus year over year at real scale. And when you see these multiples, right, we see public SaaS businesses in general, I think the median is trading around 13 or 14x forward revenue. In my mind, I don't see those multiples really being sustainable. It's just quite high. Typically, we don't see the SaaS universe maintain a multiple over than 10x for an extended period of time. It kind of fluctuates in between the 5 to 10x band. And so the companies that will, prosper are the ones that can grow into these valuations the fastest. And to grow into the valuation, faster, you need to be able to sustain a high revenue growth rate at scale, which I do believe many of these businesses will, but right, not all of them. Not everyone benefits equally from COVID. It is a tide that lifts all boats, but it definitely lifts some boats disproportionately.
Yeah, and I invest in public companies almost exclusively in software as a service companies. I have a couple companies I own, Roku, Peloton, that are more in either call it advertising or digital entertainment or something like that. But mostly a lot of the enterprise software companies. And one of the things I try to think about when I'm looking at them is exactly what you said. So sure, their price of sales multiple is a little bit elevated right now, but as long as if they're growing 50% or 60%, if they're growing their revenue 50 or 60% year over year, then even if their price of sales multiple is elevated right now, all it's going to take is 2 or 3 quarters for them to kind of grow into that. Totally. And then if the stock price doesn't move for 3 quarters or a year, really you shouldn't care that much, because then it'll be undervalued. And as long as they can sustain that revenue growth and keep that customer retention and that dollar-based net expansion rate where customers are just spending more anyways, then it should work out. But the challenge is finding companies that are actually going to continue growing revenue, right? And so you talked about it a little bit in making sure that you're invested in the companies that are kind of a piece of that, I guess you could say, critical infrastructure, or the critical part of companies doing business, and not just something that they can move away from easily. You mentioned this week being kind of big for public SaaS companies. And so I'm looking at your Clouded Judgment Q2 SaaS earnings preview, and on here, highlighted for this week, you have RingCentral today, Twilio, New Relic, Paycom tomorrow, Fastly, HubSpot, Square on the 5th, Datadog, Cloudflare, Alteryx, Livongo on the 6th. So I'd love to get in those in a minute, but last week we had Shopify, a little company called Amazon, Google, Atlassian. I'd love to talk real quick just about how, when we think about Microsoft, Google, and Amazon, the 3 big public cloud platforms, right? For me, I'm not invested in any of those companies, but I look at those as indicators as to kind of the health of cloud investment. And I think their results drive other companies' performance. Like right now, we're seeing a rally in, Fastly and several other companies, probably off the back of those strong quarters that were reported. So really long-winded question, but how do you use kind of the public juggernauts like Amazon, Google, and Microsoft to inform what you do in the private world? And then also, is there a tie in your opinion to other companies that are in maybe industries that are kind of a play off of those? So edge computing or like application monitoring, things like that.
Oh, totally. I mean, I think they're all incredibly related, right? I mean, you look at Amazon's business. Their AWS business almost did. I want to say it was close to like 11 billion in
Yeah,
revenue this last
crazy.
quarter, growing 30% year over year. And what you look at is, okay, a lot of that is sure driven off storage, but it's also a lot of compute as well. And when you think about, what the derivatives are of something like AWS growing, I mean, it's really everything, right? You have more, you're spending more on cloud infrastructure. So what does that mean? Oh, well, you're going to have to spend more to monitor it, right? And who's the beneficiary of that? All right, well, that's your Datadogs, that's your Dynatrace, that's your Elastics, right? You build more of these tools. You build more modern applications. Oh, well, maybe you want more of a modern way to engage with the users of those applications or your customers. Oh, maybe you'll adopt a Twilio. And it's you're able to adopt these other cloud tools because you have other cloud applications and infrastructures behind them. It's much harder. You're not gonna. It's much harder to marry the older kind of on-prem version to the modern tool, because usually it's one's a derivative of the other. And so I don't really look at the big players when I think about what that means for the private rounds and private businesses. I think while related, and while you always want to keep an eye on what's going on in GCP or Azure or AWS, from a competitive standpoint, I think from a market standpoint, we all know where the market's going. We know cloud adoption has a lot of room to run. We know it's accelerating. I think when I look at the public markets, the biggest question for me currently is Q2 and all the businesses that are reporting now. This is the first quarter where we're going to see a full quarter of COVID adjusted business, if you want to call it that. Q1s that ended in March and April, the March quarters were, largely unaffected by COVID, and the April quarters, had a couple weeks. So it's hard to really read into the numbers too much, but for quarters ending June, for quarters ending July, 100% of that quarter from start to finish was done in a COVID affected world. And so you see people talking about digital transformations, you see people describing how that's affecting your business, but what ultimately, the proof's going to be in the numbers. And Amazon and AWS had a phenomenal quarter. I would say, gosh, I wish I had the exact numbers. Their year-over-year growth did decline sequentially a little bit more than it has in previous quarters. So we saw a little bit of decline, right? And so it's still growing fast at a remarkable scale. Right? Like, hey, digital transformations, right? It's accelerating cloud. Maybe we shouldn't have seen so much of a deceleration, and it's hard to really drill into the specifics, the causation of that, right? I think we are going to see buyers just be a little bit more hesitant and focus more on critical spend and kind of tier 1 spend versus tier 2 and tier 3, which is why I think certain vendors will benefit more than others. So it's an interesting, potentially leading indicator. I feel like we'll write the narrative once all these businesses report earnings afterwards and make it fit. It is tricky though. Now, and especially too, since when you compare estimates or you compare the results to consensus estimates, that's also kind of a tricky exercise. And the reason I say that is, I think for the most part, estimates have been, strongly revised down, right? And so many of the businesses, I think every business so far has beaten their consensus estimates for Q2 by quite a bit. It's a little bit artificial when they're almost beating, quote unquote fake numbers. The interesting thing has been to see the guidance for next quarter, actually come in a little bit weaker. We saw that with Zendesk, we saw that with Atlassian. Dynatrace, on the other hand, had quite a strong guidance. But it's just tricky, right? Like Shopify reported a phenomenal quarter and didn't provide guidance for next quarter. Not because the business is doing bad, but because it's literally growing so fast that they don't know how to guide. So when analysts are kind of flying blind in some regard. They don't know how to guide. They don't know how to really build the right model. We're kind of sitting in unprecedented times here. I think the real the real way to analyze the data will be looking at not compared to consensus estimates, but to the growth rate, the year-over-year growth rate for the quarter we've seen, and kind of how that's compared to historical growth rates, and see if, hey, did we see a faster deceleration than normal? Did we see a normal deceleration, or with something like a Shopify, did we actually see an acceleration, which is usually rare for businesses of this size, right? But no, it's all, in a lot of ways, it's, we'll have, if we did this podcast a week later, we could be having a much different conversation. It's more speculation at this point.
Yeah, for sure. So kind of reading and I'll link to this in the podcast and I'll share it out on Twitter when we share the episode. But at the end of your Q2 preview cloud judgment article, you made an earnings prediction. You said in the short term, valuations have been stretched. We won't see massive boosts to stock prices like we did after the Q1 earnings. 10 of the 54 companies you track saw their share price go up by more than 10% the day after their earnings. Mm-hmm. Much of what you talked about as far as the strength in a lot of these companies is already priced in. But for the best businesses, the secular growth stars, which you named a few that are kind of on your list as elite companies, and so maybe we can mention those here, not for short-term predictions, but just from companies that you like long-term. You said they'll grow into their valuation much quicker than people expect. This group does not have a bubble coming. Not to say we won't see a 10 to 15% correction, or Q2 might be lighter than expected. That's normal and it'll happen. But in 5 years, if we were to zoom out and look at the trajectory of these stock prices, I think it'll be a fantastic up and to the right story with a ton of value creation to come. So I feel like what I just read there kind of summarizes a lot of the points that you made, but also what is a really important behavioral habit that if anybody is investing in these companies in public markets needs, in my opinion, needs to get a hold of, is the idea of ignoring the next potential year or 2 years and 10, 15, 20% drops or increases in the share price, and focusing on, are these good businesses that are going to grow for 5 and 10 years out? And clearly, like, you've got that mentality because that's what you do in the private markets, right? And
totally.
It feels like, and this is why I love talking about this, people invested in these types of companies publicly should learn as much as possible about like venture capital, because that's the type of mindset I think is required to be a successful investor in these types of companies in public markets.
Yeah, I think it's interesting, and the last thing that I will ever try and do is pretend to be a technical trader, right? I think there's two kinds of public investors. There's traders and there's investors, right? The former being shorter term. I couldn't tell you how to read a technical chart. Like, I know nothing about it, and I don't really ever want to. I don't really care to learn. My philosophy is I want to invest in businesses that I think will be worth, substantially more 3 to 5 years from now. I want to put some money in. I want to set it and forget it. For the ones that I really believe in, right, I'll be looking for opportunities to put a little bit more in, just pile a little bit more in every so often, every time there's a big dip, maybe put a little bit more in. And, you're constantly reevaluating the portfolio along the way to see which ones, are worth putting a little bit more in. But yeah, I want to put my money in stocks. I want to set it and forget it. I don't want to think about it. I take the mindset of, in 3 to 5 years, I think these businesses will be worth substantially more than they are today. And the idea behind the secular growth stars is, and I kind of laid some of this out in that article, but if you look at the fact that markets are bigger than we think they are, right? And they're growing faster than we think they are. You look at the unit economics of a SaaS business, things like net retention, things like their CAC efficiency payback that just lets them, ultimately be fundamentally good businesses. Then you marry that with the fact that, I think more of a trend we've seen recently, usually the leaders in categories, they're grabbing more share than they used to, right? Markets used to be more fragmented than they are today. Currently, I think we see more of both the revenue and the equity value, accumulate with the leader in a category. And usually what happens then is the leader in a category, they benefit disproportionately from that market growing faster than people expect. They benefit disproportionately from better unit economics, right? They kind of get that compounding effect, which is, part of where the secular growth stars come from. And I think that will continue. I don't think that's going to go away anytime soon, which is why, I like to not, I think investing in ETFs that kind of cover cloud companies is a great way to start. And I think it's a great way to get good exposure to all these macro trends. But I personally like to make bigger, concentrated bets with the few that I really believe in. And I haven't invested in every company I listed in the secular growth stars. Some of them I just don't understand quite as much as others. Some of them I missed. Some of them I was wrong about. But that's where I try and park all my money, in ones that I think are going to benefit disproportionately in the long term from a lot of these cloud tailwinds.
So we've talked a lot about VC, clouded judgment. I also asked for questions on Twitter, and I don't know if you cheated and looked at these or not yet, but I've got some questions for you. And the first one, I don't even know if this is true or not, and I can't even believe that this person, I love all of our followers, but I can't believe this person follows me and supposedly knows you. Jerry Rice Jr., so Flash 80 JR. The first question is, ask him what he thought about me in high school. And I'm going to guess that you probably didn't hang out with the nerdy kids like him in high school. You probably stuck mostly to athletes, right?
Yeah, he was a grade older than me, but we only had about 40 kids in every grade. So it's a smaller high school. So you kind of know everyone.
Yeah. And he was probably in band and stuff, and you hung out mostly with athletes, right? So you didn't know him that well. Exactly. Okay, that's interesting. In the post he said small world, which is crazy. Small world out there.
Yeah.
All right. So we got you warmed up. We had a question from Humbled Twig, and they just said, would love to hear Jamin's take on all the recent IPOs and top 3 picks out of them. So don't necessarily have to pick your top 3 picks, but are there any in some of the ones that have come public? BigCommerce, Lemonade, Encino, I think Agora, a couple others. I personally have not invested in any of them, and I'm just kind of staying away from the IPO scene right now because I've got the companies I understand and familiar with, but would love to hear if any of those are interesting to you.
Yeah, the IPO scene has been interesting. I'd say just the general mania around software and even technology, more broadly, has, I think, forced a little bit of kind of an irrational behavior of the recent IPOs, and it's compounded by the fact that when these companies go public, most of the shares are locked up, meaning existing shareholders prior to the IPO can't sell their shares until it's generally 6 months after. What that means is there's a limited percentage of shares as a percentage of the total that actually trade, and we have a small supply of tradable shares. A couple swings in demand can cause big changes in price. So you look at a company like a Lemonade, right, which is trading like a SaaS company, which is their valuation on a multiples perspective is just totally different than what insurance companies trade at. And should it deserve a premium to classic insurance? Yeah, I absolutely think it should. Should it trade like a SaaS company? No way. That's my personal opinion. You even like Encino, who I like that business quite a bit. I think they built a super, super interesting product. I think the reality is financial services as a vertical, it's been trickier because there are, some might call it a limited market, right? There's only so many banks that matter. The sales cycles are usually much longer. It's not as much of a high velocity business. Implementation takes a while. There's usually professional services involved, right? And so margins are impacted. Generally those businesses trade at a little bit of a discount to overall SaaS. Encino for a time was trading like a top 10 pure SaaS software business. Do I think it should sustain that? Probably not, but I still think that business has quite a bit of room to grow, right? Financial services in particular are an industry that that hasn't moved to the cloud quickly, right? There's still a lot of room. There's still a lot of on-prem stuff in banks, and so they're benefiting from that. I look at some of my favorites. I do really like Agora. I think they have a lot of tailwind, current tailwind, right? They have the classic COVID tailwinds, if you want to call that. People are looking for ways to engage with others in a real-time manner, and they offer an amazing, API product to do that, right? Similar to how Twilio is more of like the jack of all trades around communication. You can text, you can video chat, you can voice call, and you add that via a programmable API. Agora is more focused on that real-time video, real-time communication. I think they've built a phenomenal business. ZoomInfo is an interesting one. I generally haven't been the biggest fan of data businesses. I think it's harder to build moats. I think ZoomInfo has just gotten to the size and scale where their moat is they just have better data. It was just typically a harder moat to build. I think that's definitely an interesting one. Big commerce definitely worries me a bit. Going back to my investing philosophy, investing thesis, I like backing, big markets, great products, but then that third key bullet was the leaders in the market, right? And so it's hard for me personally to get excited about a big commerce when Shopify is in the market. There might be a better value play there. But again, I like backing big multiple long-term winners as opposed to the value bets, right? It's why I own quite a bit more Datadog, right, than an Elastic. Both phenomenal businesses, but it's slightly different philosophy.
Yeah.
So it's been interesting. Yeah. And I'm sure I'm leaving out others.
You hit on the big ones.
Yeah, Jamf was the Apple device management one. That one also worries me a bit because Apple just bought a company. I believe it was called Fleetsmith. That's a company more in my realm, venture funded ones. And so, when Apple's buying an Apple device management product, it worries you a bit. But I think that one had a nice trading debut. I haven't really followed it as closely.
Yeah.
But yeah, I would say, maybe Agora and ZoomInfo would be my favorites of the bunch, with Agora probably being the favorite.
Yeah, awesome. Thanks. So we have Quad Sparky, who asked just about how total addressable markets for SaaS companies have expanded or shrunk over time, and which companies or markets you expect to be larger. I think we pretty much answered that when we were talking about TAMs earlier. So we'll jump to the next question. It's a great question, but we kind of already hit on the TAM topic. This is an interesting one from Phil_Sylvester. Where do you get a company's customer acquisition costs and net retention rate, aside from them just telling you? How much do you trust these metrics, and if they're calculated by the businesses themselves and not audited by a third party? So maybe there's two parts to that. It's the private side, but also the public side as well.
So on the private side, we'll calculate it. We generally, though, this is the benefit of a much longer due diligence process. We'll engage with the company over weeks. We'll get financials from them, not just the income statement, balance sheet, cash flow, but customer files, all that. So on the private side, we'll calculate net retention, and we'll do that specifically with the cohorts. We will look at all the customers acquired in every quarter and see how their spend changes in every subsequent quarter. So that's a number we'll track and we'll calculate. Kind of similar thing with payback. We can just get a little bit more granular. When we look at public metrics, the payback is a metric I calculate purely based on the other financials. Net retention is not a number I calculate. There's just, you don't have close to enough data to calculate it yourself. For a lot of businesses, they report it. I would say you do have to get a little bit in the weeds to make sure it's apples to apples between every company. Most businesses will look at the net revenue retention in the way I described, or they'll call it dollar-based net expansion. Sometimes they're calculated differently. For the most part, if you look at their 10Ks and 10Qs, they'll define it, and they'll say things like, this is inclusive of customer contraction or lost logos. Sometimes they don't include contraction or churn. And what that means is, let's say you had 10 customers a year ago who were paying you $100,000. Currently you have, 9 customers who are paying you, just make it simple, $100,000. If it's not inclusive of churn, you would have, just 100% net expansion, which is basically like no change. Some businesses will say, hey, we're going to strip out all the customers who left from the beginning cohort and just look at how the business has changed, who were there from start to finish. Usually they don't do that. The numbers they give you, I would trust. Being on the banking side, every number that's in one of these documents is heavily scrutinized by a team of lawyers, right? And so I would trust it. The payback stuff, that's all calculated, and it's usually a bit more of a swag. It's not going to be an exact number, but when you calculate the metric the same across the universe of businesses, you can at least benchmark one company versus the other, right? So that I think Zoom had like a phenomenal payback last quarter because their revenue skyrocketed. They're not actually paying back that customer acquisition cost in exactly 3 or 4 months or whatever it is. I use it more to benchmark the relative performances of each businesses rather than looking at the absolute value.
Yeah. Another thing, and like you said, there's little asterisks basically at the bottom of the 10Ks, 10Qs that outline how these different terms are calculated.
Yeah.
I own shares of Twilio and I like the company. I owned shares a couple years ago and actually sold them after the SendGrid acquisition because I didn't like how Twilio was claiming they had 75% revenue growth when really they only had 75% revenue growth because of the SendGrid acquisition, and really the organic revenue the growth rate had actually dipped down to like 30 or 35%.
Yeah.
A couple months ago, I bought shares again. I've had some for the whole time in a rollover IRA that I didn't touch, but in my more the account that I guess you can say manage more actively, I bought shares again because it feels like the business is more relevant than ever because of COVID. And finally, I think Twilio Flex, the programmable call center platform, is actually going to start to grow, which is sort of why I was invested in the first place. I was a consultant and working at one of our customers, which was one of the largest cable companies in America, and just seeing all their call center and contact center stuff, I was like, wow, this is a major need. But then Flex never really took off. So I think that's going to happen. But Twilio, they're one of the most impressive things when you look at the company is the amount of customers they have and the growth of customers. But then when you dig down, they count anybody that spends more than $5 a month with them as a customer.
Right.
Though they're also counted in the dollar-based net expansion rate, anybody that spends $5 or more a month. So I guess it just goes to show like you've got to look at those details of how they're calculating that dollar-based net expansion rate. And I guess at the end of the day, if it's 145%, it's still 145% because that captures the small customers and big customers too.
Sometimes people strip it out though. I mean, you really do kind of have to read the fine print to make sure it's apples to apples. I think Zoom Info, they had, they have a bunch of really small businesses who use their data feed. They reported two numbers. They reported an overall number, which I think was like 108, 109% or something like that. And then they reported another number, which I think was more of the tagline number, which was something in the 120s. That was, this is the dollar-based net expansion or net revenue retention for every customer paying us. I don't remember what the number was, like more than 10K a year or something like that, right? And so, you kind of have to just figure out which one you care more about, right? Because it really isn't 130% net expansion business. It's really more 109, and they're kind of giving you these two metrics. So it is important to read the fine print to see what the number really is and what it's representing.
Really, one of the last questions I have for you, Jamin, thanks for your time, is one of the metrics I look at, and you haven't mentioned it yet, is sales and marketing spent as a percentage of quarterly or annual revenue. And the reason I look at that is because for software companies, I'm willing to accept them spending more on sales and marketing when they're early. If they prove product market fit, ideally they should have to spend less and less on sales and marketing over time, and they can put that into research and development or whatever. Just wondering if that's a metric. Do you think about that metric at all? Or is that captured in the other stuff you look at?
So it would, I think part of the reason I love the payback metric so much is that I think it factors that in and it encapsulates ultimately how effective is your sales and marketing spend. Because the high level way of, before you get into the months, right, the inverse of it is the magic number, which will basically tell you, for every dollar of sales and marketing spend, how much, revenue, or I guess in my case, how much gross profit are you generating for every dollar of sales and marketing spend. So I think the payback metric it's a great way to factor in efficiency. It kind of takes into account the burn, it takes into account the sales and marketing as a percent of rev. I think, at least this is just my view, it kind of factors in all the things you'd care about from like a broader efficiency standpoint. And then it's just one less metric to track, right? Like the fewer metrics you have to track, the better mental benchmarks you can build. I think it definitely matters, and you want to absolutely be looking at sales and marketing spend. Whether your personal preferred metric is as a percent of revenue, or something like payback, or maybe even something like a net burn. Everyone kind of has their own secret sauce. Mine just happens to be the payback metric.
Awesome. Okay. And final question, not necessarily looking for a book recommendation, but just resources. If you have a favorite resource or two, maybe it is a book for anybody that's interested in learning about venture or these public types of software as a service technology companies, to just learn more about them and maybe get started.
My colleague Tomasz has a phenomenal blog Tomasz Tungus, that breaks down. This is more from like the operator's perspective, as opposed to people looking to invest in these businesses. But he does a phenomenal job breaking down and defining the metrics that matter, as well as just looking at, certain things operators would care about. If you're, his are more of like the quick, punchy, couple minute posts, as opposed to like the longer, deep dive things that are going to take you 10, 15 minutes to read. But I mean, he's got so much gold in his in his blog over the years that, I almost wish there was a way to repost things from years ago. There's a lot of good stuff in there.
Awesome. Okay. And we'll share that out and make sure everybody can find it. I've also got two to recommend, Jamin on Twitter, and then cloudedjudgment.substack.com. Thanks so much for your time. I had a lot of fun. Hope you enjoyed it as well, and hope the listeners had a good time too.
Yeah. Thanks for having me. It was a lot of fun.
All right. See you, Jamin.
Take it easy. Bye.